Okay.
Hello, ladies and gentlemen, and welcome back to the next episode of Prepared, Aware, and Ready to Buy with James Murphy of Advisors Mortgage Group and Lori Savino with Corcoran. How you doing today, Lori?
I'm well, thank you. Hey, James, how are you doing?
I'm doing fantastic. A little cold out there in the this bitter state of New Jersey right now, but great overall.
It is so cold, and next week it's going to be frigid, so not looking forward to that.
I
Definitely,
know.
but
I
excited to
just
be here on another episode with you, and
as am I.
discussing all things real estate and especially mortgage rates, which is what the number one question I get from my clients is, when are the rates going to go down? So, James, give me
Mm.
all your wealth of information. What's going on with the rates? Let's chat about it.
What is going on with the rates? Well, I believe it was Yogi Berra that said it's hard to make predictions, especially those in the future. It is one of those things where, although, we have a habit over here of reading technical data and reading the charts and studying the reports that are coming out and trying to really handicap where rates are going to be. These days, it's a little bit more difficult, somewhat more complicated, and a little bit of a crapshoot. It really, what you see happening or what you think is going to happen can totally be derailed or changed by one comment from one politician or one Fed member.
Mm.
So, when we do get questions about rates a lot, obviously. And, what I like to tell people is if I could have any control over the rates, one, I would be far wealthier and I'm sure I'd have way more friends. That said, we
Like,
do have projections. We have expectations, and we look at a couple different factors to try and gauge where we think rates are going. A lot of it has to do with inflation. I mean, let's face it, interest rates are higher right now because of inflation. And as many of you may know out there, inflation, it basically erodes the value of a bond. That's why rates rise, right? If you were giving somebody a loan,
mm,
you were lending money, right? You'd be focusing on how much interest you're making on that money and how much money you're bringing in. Well, inflation is too many dollars chasing too little goods, right? And that's what makes inflation so devastating to us as consumers. So, as an investor, as you've offered a bond and you've locked in on that rate, you have a fixed return, and you're expecting that return to stay that number. Well, inflation erodes that number and it drops the value. So the way you offset that is by increasing interest. And that's how you maintain your return as an investor. So, as inflation has been really running rampant, we've seen these rates climb. And over the last year or two, we've seen rates climb awfully high. I mean, we've touched in the 8% range in 2023, 24, and it's just brutal out there, right? So obviously we're all looking for some reprieve with these lower rates. So that's going to come with inflation coming down. And as we've been seeing with these recent reports, CPI, PCE, uh, they're showing inflation come down. We're looking at the core rate. Now, the main report that the Federal Reserve looks at is the PCE, which is personal consumption expenditure. Excuse me, sorry, someone's distracting me over here. Expenditure. So that being said, that right now, the last report I believe was somewhere around 2.8% back in November, and they're really focused on getting that number down to 2%.
okay.
Now, the thing that frustrates us in the industry is we're looking at that number and we're looking a little bit deeper into these reports and we're seeing, lagging indicators like shelter that take up almost 18% of that core inflation number. Well, that's a lagging indicator months behind. So as we all feel inflation slowly coming down, things are getting a little bit easier. The inflation number is lagging, right? So we don't see that come down, which obviously uh, causes the Federal Reserve to hesitate on their Fed rate cuts. And the cuts are really what we're looking for to reduce these rates because the Federal Reserve is the Fed funds rate is the cost of money, right? So as the cost of money comes down, then the money that the lenders or investors are lending out, that becomes cheaper too. So right now, the dot plot for 2025, this is just a forecast of how many we will see from the Federal Reserve. I believe right now is around 50 basis points. So that's two cuts. They usually cut in quarters. Now we see plenty of.
So you're predicting sort of two cuts?
Well, that's what the Federal Reserve is stating right now. Now there's 19 members of the Fed, and the dot plot basically is an opportunity for each of these members
Mhm.
to give an anonymous analysis or guess, if you will, or expectation of how many cuts we're going to see. Now, the majority of them are looking at two cuts, it's 50 basis points, which would bring the Federal Reserve rate down to about 3.875. Now, myself and my team and the people that we're following, we believe that you're going to see closer to 3 or 4 cuts. There's one Fed member that believes you can see 5 cuts, which, hey, God bless him. I hope he wins.
Be great, but I definitely don't think so.
Yeah. So, but now that being said, as these rates as this Fed fund rate comes down, it provides some easing in the market. And one of the reasons why is because if you're an investor out there, and there's two sides of the market, right? There's a stock market and there's a bond market, right? And money's going in one side or the other. So when one is up, typically one is down. Um, and the Fed funds rate is tied to things like money market accounts, right? Where a money market, you're putting your money in there, you're seeing a return. That's an attractive return. So you're going to invest in that arena, right? You're putting your money in money markets. And as the Fed fund rate comes down, well, that return comes down as well, right? The yield on that investment is reduced. So what do investors do? They start moving their money into things like bonds or
Mhm.
treasury notes. And as the investors purchase the bonds and the treasuries, as the buying takes place, that is going to reduce interest rates. So we believe that you're going to see rates come down. Right now, we're currently in those high sixes, low sevens, depending on credit and the scenario of the loan. But we do believe that you'll see a nice little improvement in the 10-year treasury because of inflation coming down. And the spread between the treasury and your 30-year fixed mortgage rates, those typically, right, we believe that spread is going to go down to about 2.25, which basically means if we see this 10-year treasury come down to historical levels, we're going to see that we believe that comes down to around 3.6, 3.7. Currently, we're in that high fours, 4.6. We touched higher than that recently, and we were looking at approaching 5% on that 10-year treasury note. But thanks to some nice inflation numbers that recently came out, we've seen a turn or a reversal. So we do believe that with that spread in place, we see rates, we see the 10-year coming down to the 3.6, 3.7 range, and that spread is reduced to around 2.25. Our expectations are to see rates around high fives, 5.75, 5.875. And anytime I say this, I will tell you the next question typically, and you might be ready to say this to me, Lori, is, all right, that's great, but when,
All right.
right?
That's the number one.
Now, I do believe it's going to take some
Buyers
time.
waiting on the sidelines, and this is the issue. Because they don't want to get into the game, they don't want to start looking. They just want to know what's going on. So that is the
Yeah.
number one question. When?
So when, I believe we're going to see this around Q3, Q4. I think we'll slowly start making our way down to as early as next month. And the reason why I think that is because of with inflation and the PCE and the core numbers, there's numbers that roll over each year, and there's a replacement of each number, right? So there's an outgoing number of core inflation that will be from 2023 that's replaced with the 2024 numbers. Right now, we're obviously replacing 24, and it's a month behind or so because most of these factors, these indexes, they're lagging. So I believe it's not until January of this year, which is this month, that we're going to start to see somewhat of a headway by replacing, in February, excuse me, let me rephrase that. January, we're replacing December's of last year, still a little bit on the high side, but January's of last year will be a nice replacement when we replace a bigger number with a lower number of this year. So we're going to start seeing that number come down. A little bit of dancing around there. I feel like I may have gotten a little confusing. So forgive me if you're listening and just thought to yourself, what did he say?
Give us a
What I
quick
basically,
summary then. It was great information. Let's summarize that for everyone and kind of say,
yeah,
what do we think? Couple of, good blurb.
just to summarize that, I think we'll start to see rates come down as early as February or end of January, going into February. I think that's when we start to see some nice improvement. And we're going to go from those high sixes to the mid sixes, and it's never a straight line, so there'll be up and downs along the way. But long and the short of it, I believe we start to see rates and improve as early as February. And by the time we get to Q3, Q4, I think we'll start seeing some really nice rates in the fives.
Okay. I have a question for you. So what determines somebody's rate? So for instance, a lot of my clients, someone gets a better rate than others. And what are the key factors in that?
Great question. So interest rates are largely based on the loan scenario itself, right? The market will set a base rate, right? And the market will say, here's where rates are at today based on this note and this bond and so on, and activity that's going on in the market. And rates fluctuate throughout the day, every day, right? So you'll see rates in the morning in one number. They could go flat, we call that a flat day where rates just kind of stay, or we could see them go up and down by the end of the day. As far as what goes into these rates, when we look at these scenarios, you're looking at things like the credit score, obviously the FICO, and everything with rates are tied to, is correlating with risk, right? Higher the risk, higher the rate. So when you have someone with a lower FICO score, the Fannie Mae deems that as a higher risk, hence higher rates.
Right.
And the way that rate goes higher is through what we call loan level price adjusters, LLPAs. So if you're in a riskier scenario, meaning you're putting less money down, maybe you're buying an investment property or a multifamily where there's other factors that are contributing to the well-being of the collateral of the loan, right? The property.
Right.
Or you have, like I said, a higher debt to income ratio, or you're buying something else other than a single family, apartment, condo. Then you have something called loan level price adjusters. These are add-ons to your interest rate based on those scenarios that I just mentioned. So my job, what we do here at Advisors, is our effort is to reduce those LLPAs, get a hold of the buyer as early as possible in the transaction, so we can totally do an assessment of where are you at, here's where you'd be at, based on your current risk levels, right? Based on your current credit score, your current down payment, and your current debt to income ratio, and currently what you're looking at, whether it's condo or single family.
Great.
And then we work on reducing those in any way we can, increasing the credit score by looking at the credit report, doing an analysis. How can we get the scores up? What can we do to put this borrower in a better position to finance? So, as far as rates go, they vary, and there are other factors out there, such as your income levels. If you're making less than $143,000 a year in the state of New Jersey, in most counties, then you're going to be able to get those LLPA level loan level price adjustments, LLPAs waived, and that's something that's going to definitely change your interest rate from someone who might make more money than that. You could have somebody with a lower credit score putting less money down, but they fit right within that range of under that income source. And they may have the same exact rate with someone putting 20% down with an 800 credit score.
Right.
Because their LLPAs are waived. So how do we get someone a great credit score? Well, we structure their loan scenario to the best that it can be structured by working on everything that we can work on. And then the other factor is timing.
Right.
One thing we do here is, obviously, as I mentioned earlier, reading that technical data, making assessments based on reports coming out and what's coming out down the pike, and trying to gauge when we should lock in the rate and when we should float the rate. And in most cases, floating the rate makes a lot of sense given a rate declining market, right? And that's currently where we're at. We are, like I said, rates don't move in straight lines, but we are trending down. And we did hit a little spike with these last jobs numbers came out. Inflation numbers didn't help. But that being said, the most recent ones did, and we are seeing a reversal. So the trend is our friend, and that's how that's a saying we say here, trend is your friend. So you watch that and you read the trend lines, and you gauge when you should lock and when you should float based on those, as well as what's coming down.
All right, that's great. Well, so the other big news that started on January 13th is the buyer's agreements. So on my end,
Yes.
yep, it is in full force now, as we know, with the changes in buyers paying, or potentially buying, buyers paying the compensation to the agent. So the big news, as everyone, not big news or continuing news, I should say, is that the commissions are decoupled now. So the sellers are paying the seller's agent, the buyers are paying the buyer's agent, right? I am seeing, I would say 80–90% that the sellers are still paying the buyers. But if you are a buyer's agent, I should say. So if you are a buyer, you are going to be asked to sign a buyer's agent agreement. So you may have to pay your agent their commission. It could be decoupled. And it's something that I'm talking with my clients about, and being, fully transparent. So every single house that we go to see, you will sort of kind of know what's going on in terms of, is there commission, is there not? Some agents will say, just put it into the offer. And so we are, there's a lot of different things right now. So we will sit down, we will talk about all the different scenarios. You can sign something with me that is for a shorter term, for just a property. There's a lot of different options. So I don't want you to get nervous about that, but that is full force now. So you do have to sign a buyer's agent agreement with any agent that you want to go see a house. And that started officially on January 13th. So that's my news for now. The market is heating up. There's more inventory coming on the market, which is great. We are moving forward. We still do have the bidding wars. And so you have to position yourself with a very good agent and mortgage broker, because you have to be able to, both James and I have won bids because the agent has spoken to James and they feel really comfortable with him and his products. So we know we can get to the closing table, which is the most important thing, and have that. So that's really a little bit about my news of what's going on in the world of real estate. So this has been great, James. Anything you want to add before we sign off?
No, I think there's so much to talk about, but we don't want to make we never want these shows to go too long, because I feel like it's definitely easy to lose interest.
Yeah.
But on the next episode, what I'd like to talk about maybe is where we think values are going to go, and where we think these home prices are going. I know that's something you could definitely touch on,
Yeah.
right? From what you're seeing these values. Let's give them a teaser here, Lori, before we sign off. Real, and we'll elaborate on the next episode. But where do you see home prices going in 2025?
Yeah, exactly. That would be great. We can discuss that. We wanted to really just give you like a welcome to the new year, talk about interest rates, what's happening, talk about the buyer's agreement that you need to sign now officially, and that so you're ready. So contact us if you are looking to purchase a home in both either New York or New Jersey, and we'll get you started.
All right. Well, that's fair. Then we'll leave them with that. And let's just say thank you to all of those watching today. I want to thank everybody here for tuning in to the next episode, or the latest episode, I should say, of Ready, Aware, and Ready to Buy, which is actually Prepared, Aware, and Ready to Buy. And you've been
Right.
watching.
Yes.
It's one of those days. But you've been watching Lori Savino with James Murphy, and we're hoping you guys got some knowledge, some wisdom, and some benefits from this episode, and we'll see you on the next one.
Right. Have a great day.